Good morning, everyone. This fine Thursday, Mike and Corey here today. Going to talk about some exciting topics. 401ks have reached a threshold, according to the Wall Street Journal. And then we're going to talk about Temu adjusting already to the de minimis tax on China. As companies do, they will adjust to whatever laws are put in place. Unfortunately, we saw some bad earnings from Roblox. And then Corey's going to talk about a myth, stocks and risk. So I'm looking forward to hearing about that because some stocks are high risk and some are not. So we'll get his perspective on that myth. But before we get started, I will remind you this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So, this is going to make me sound a little bit old school, but I still like to read the actual newspaper. There's only like 6 of us in my town. I was taking a walk one day and I saw a house that had the Wall Street Journal in front of it, paper form. I don't know that person, but I'm ready to go knock on their door so I can get to know them because we're like a small club that read the actual paper. I haven't done it yet. But I saw this article in today's Wall Street Journal and, caught my eye. It was right on the front page. The 401k has reached a tipping point in its takeover of American retirement. Now,
Wait, we have to start tipping in our 401ks now too?
yeah, there's like a button. There's a button every time you just click tip.
Oh man, what are the options? Where does it start?
Oh,
All right.
oh my gosh. Well, anyways, for those of us that are my age, we what a pension is. And for those of you that are out in a pension, that's amazing because they are declining and declining further and down. I imagine when you get to Corey's age, although he came out of the teaching, so maybe he does know what a pension is, but anymore, young people, there's no such thing as a pension. I mean, unless you go into certain government jobs, pensions are few and far between. The 401k has been there. I don't remember the first 401k I got. It's somewhere in the 90s, but this is what's out there all the time. This is your vehicle for saving for retirement. 401k and a Roth IRA. Those are your two best ways. But the gist of this article is it has now reached 70% of private sector employees have access to a 401k style retirement plan. And generally, these are you put some money in and your company matches some of it. 50%, sometimes it's 100%. That's great. And I always tell people for saving, the first thing you always want to do is get that match, whatever that match is. If it's 50 cents on the dollar, you're getting a 50% return on day one. There's no investment that Corey and I will ever put you in that could get 50% return on day one, no risk free. It's just impossible. So that is free money that you absolutely need to take. Now there's pros and cons. 401ks, the advantage is when you switch jobs, you can roll your 401k into an IRA or you could roll it into your new employer's 401k. I'd always recommend rolling it into an IRA because you have more flexibility on your investments. But um, you know, today's world, most people don't go work at a job for 30 or 40 years. That's where the pension really did better. They tend to job hop. I say job hop, but 5 years, 10 years, switch jobs, take that 401k with them. So with this, they show the percentage, share of people that are actually participating. So just because it gets offered doesn't mean you're participating. It's up to 50%. So there's your threshold that we're seeing. And then the other thing is more companies are starting to default right here. They automatically enroll you into it. Now, it used to be when you started a company, you had to choose to be in it. And guess what? Some people just don't do it. So now you can certainly opt out of participating, but just that they opt you in instead of opting you out, that automatically increase the percentage that save. So these are all just interesting concepts with a 401k and a threshold. And I believe 401ks are where we're going to have the future for employment retirement type programs. We do have the ability to manage 401ks. And sometimes you can do an in-service rollover, which I think David covered one day, that where you can roll it. The disadvantage of a 401k, you usually don't have a lot of choices. And that may be good or bad. Not having a lot of choices on what you can invest in, whereas in a IRA, you can choose, or with us, you can choose whatever you want. I mean, we can help you choose whatever you want. So you can get the best investments. But I always tell people when I meet with them, I'd rather you be in the market than not in the market at all. I'd rather you be in a 401k with few choices in, more expensive than I want mutual funds than not in at all. And I'd rather you get that contribution. So, Corey, did the schools have 401ks, or did you actually have a pension there?
Yeah, pension. But my first job for working for Targa in Houston, we had a 401k, and yep. I mean, it's a great vehicle. Maxing that out as early as possible, as often as possible, is going to, or maxing that match is.
Yep. I was going to say, maxing the match is critical. And then I would say after you max the match, then you want to go to a Roth IRA, or you want to go somewhere else. But that match is key. So
because you are recreating your own pension now. So you're not getting that from your job, or from, even in some cases, from the government. Even in teaching, many of the pensions, the quality, the requirements have deteriorated significantly. So at this point, you are your pension.
All right. Okay. So other things in the news, boy, it seems like it was a long time ago that we had this tariff panic, but it really was just last weekend. So we're already seeing news on people, companies working around the tariff. So I mentioned Temu and Shine. We're already seeing Temu steering users to local products, so they don't have to pay that tariff or de minimis exception, or they're getting away from it. So companies are going to adjust to whatever the laws are, and there's Temu being agile in doing that. I just want to show that. Another thing, Roblox. I remember my kids played a lot of Roblox. Unfortunately, they came out, gaming industry gloom. And, I scrolled down here and I saw Electronic Arts also disappointed. These comprehensive game systems, and I don't remember, I might have played Roblox a little bit with my kids, but they create like a secondary monetary system in there. Very fascinating. And I remember, asking my kid, what do you want for your birthday? Oh, I want a Roblox game card. Okay, so I'm going to pay 25 real dollars to get you 25 fake dollars that you can convert into fake currency online. Okay, whatever. As long as you're happy, I guess buying this or buying fast food at McDonald's, what's the difference? So anyways, I just saw this out.
Mike,
Corey, did you play some Roblox?
What'd you say?
So did you play some Roblox?
I tested it out for myself at one point, just out of curiosity. Some of the students I had talked to were, like, oh, you should try this out. My kids tested it out. I never really understood the draw of the product. A lot of the games are, they're very basic and kind of repetitive. And so I didn't understand how they were expected to grow this user base, which that's what they missed on. They missed heavy on their daily active users or whatever. But then I will say one thing that is pretty cool about Roblox is that it does sort of democratize it. It's almost like a YouTube for games where, anyone can go create a game, and if it takes off and people pay to play your game, you can kind of create your own small business inside the game. So I do think that's cool, but just the overall product, I don't know that it has staying power, but we'll see.
Very cool. Yeah. So I thought just before we turn it over to Corey, I would revisit. This is a year-to-date S&P 500 graph, And you can see year to date, it's up. I can scroll down and see it's up 3%, which is good. And like, look at the dip for the tariff panic. Even at this point, is that really even a dip? I mean, I guess I think this dip here is deep seek. So there's your deep seek dip, and then here's your tariff panic dip. And I don't remember what this dip is over here, but I mean, this is the point is, you know, when these things come out, the news people have to make news. They got to have something to talk about. You know, so you know, I don't know. I don't panic about it. Will there be future tariff issues and market changes? Absolutely. There absolutely will. But I just wanted to take a step back 5 days later. You know, it's kind of like the market is not quite to where it was last Friday, but pretty close. So with that, I'll turn over to Corey, and he'll talk about the myth of risk in investing.
Yeah, so Y charts, which is where Ankerstar Wealth does quite a bit of research on investments and model building, things like that. Y charts releases some of their own information through blogs and their own research. So one of these decks that they put out is myths in investing, and there's quite a few here, and I might hit another one another day. But for today, I wanted to cover this one. So stocks are too risky. Now, as Mike said, DeepSeek this week, tariffs this week, or DeepSeek last week, tariffs this week, something new every week. Last weekend, crypto had its largest liquidation event in history, larger than the FTX blow up. And even many of those crypto holdings are kind of steady at this point after the largest liquidation in history. So there's a risk, right? And people get scared. Well, it's too risky. We've all heard someone give us that line, and this is one of those myths on investing. So YChart says volatility is often misunderstood as excessive risk. Over time, volatility may lead to growth potential. Volatility, you know, things like this week, it does give you a chance to buy things that you like at a little bit cheaper prices. I knew people who were buying Nvidia a week ago, people who were buying Google that was down 7% yesterday. People constantly are trying to take advantage of some of this volatility and can be rewarded for that. But generally speaking, the S&P 500, the Russell 2000, the Treasury Fund, long-term Treasury Fund total return, and then we'll kind of focus on just those for now. But you can see those cumulative returns over since the early 1990s. Stocks have outperformed. Small caps are not too far behind, but they've done very well. And then that long-term Treasury Fund has done okay, but it is dwarfed by stocks. So equities carry higher levels of risk and reward than bonds or cash, while okay, so let's look at the standard deviation of these moves. So this is the volatility here. Small caps have the highest volatility. Makes sense. They don't have as much of a moat around their business models. Many times maybe they're trying to disrupt an industry, create a new industry. There's some volatility around that process. The S&P 500 volatility is below those small caps, but it's higher than those treasuries. And of course, the treasuries can kind of make people feel a little bit safer because they get a little less volatility, but how you feel and your returns, you know, are two separate things to consider. I wanted to just share this too. So, you know, you look at a chart of the S&P 500, it's going straight up. And I'll spare you this whole conversation, but this is the S&P 500. If you can see my cursor, you've got dividends and buybacks. So you can see what's happening with dividends over time. It's basically a straight line up for the S&P 500. Even in the great financial crisis, there was only a very small dip. And then buybacks, similar trend. over time. They're increasing. So then they have this dividend and buyback yield. So let's say the S&P 500 goes up, down, sideways on a given year. These are the kind of those underlying yields that you've received as an investor in those given years. 2018, a volatile year, but 6% was returned to you as an investor that year. 2019, 4.5, 2020, 2021, you can see. So, you know, whether or not you're seeing growth on a given year, what's happening under the surface is money is being shared back to you, and over time it's this unstoppable force higher, and pretty cool. You know, when you compare that underlying yield to what you get in treasuries, stocks don't really have to grow that much in terms of earnings and revenue to beat treasuries, and many times they do grow earnings and revenue a lot. That's
Awesome.
all, Mike.
Thank you so much. Very informative. Markets in the green. We'll see how this week ends up. We'll see what this weekend holds for our next bit of news, but things are going as expected. It's been a good year so far. It's only February, but it's been good so far. So just keep that in mind. Have a good one. Thanks, everybody.